In almost every scenario with the types of families we deal with, taxes is the single largest expense every single year. 99.5%, about 5,973 pages tell you how to avoid paying taxes.
Welcome back, Novello Nation, to another episode of the Aaron Novello podcast. We have with us a very important person that you're going to want to spend some time with and listen to. He specializes, we were talking about this off camera, in a particular niche, which is tax efficiency. He calls it being tax smart. It is Justin Cramer. He is the president of Harbour Private Wealth. I appreciate you taking the time to be with us here today, brother.
Yeah, thanks, Aaron. Thanks for having me on.
100%. Now, I actually had the good fortune of coming in contact with you. I was in Myrtle Beach visiting a buddy of mine, Greg Sisson. He's one of the top agents in the country. And you were doing a talk there, and I got to hear some of the things you were specifically within that niche of tax efficiency teaching the audience. And off camera, we talked about like, okay, well, which I really appreciate. You're like, hey, I want to add value to the audience. So maybe two things we can focus on is how does this matter to me as an agent? Let's say I'm an agent out there that is doing well and notices that once you start to do well and earn a lot of money, a gigantic tax bill comes with that. So you're like, hey man, how can I be efficient with that? And then also how you can, kind of serve high net worth clients. So I guess if you could start off a little bit with how you feel this matters to agents and, them being able to not only earn a lot of money, but retain a lot so that way they can multiply it.
My wife reminds me there's one thing I can do, which is talk. And so I want to make sure we're talking in a specific direction.
Sure.
Are we talking specifically about real estate ownership and investment and the benefits associated? Is that
Yeah, I think that's fair. And then I think it's also too getting clarification around like as a high income earner, why is tax efficiency important? And then from there, perhaps like what you just mentioned, and then from there, something like perhaps like the real estate professional status and things of that nature.
Yeah. Well, let's just start at the top with something that Mark Twain, the famous writer, said. He said, the only difference between the taxidermist and the tax man is at least the taxidermist leaves the skin when he's done. And most of us feel that way, right? When especially if you're a high income earner, chances are you're a business owner or a 1099, and you're paying federal tax, state tax, oftentimes both sides of FICA, which is 15.3%. Your tax bill easily exceeds in most states 45 to 50% if you're a true high income earner, which is crazy to think about. Iceland is a socialist country and they pay 77% tax. We are supposed to be a capitalistic free market society paying north of 50 or 55 and sometimes even higher than that. So our belief and our conversation with clients across the country is in almost every scenario with the types of families we deal with, taxes is the single largest expense every single year. But one of the things that is been super impactful for me is to understand that there really is a different way. That there are lots of things in life we can't control, but there are some things we can control. And then why don't we actually take control of those things? And managing on a year-to-year basis and over a longer period of time through tax smart or tax efficient wealth management and wealth planning, you can actually significantly minimize the amount of money you pay out to Uncle Sam. And so if that money's not going out to the federal government, it's coming back into your own wealth structure. And so I am convinced that not only for most families, high net worth and high income earners is income tax is your single largest liability over your lifetime. It's also your greatest tool for long-term multi-generational wealth building if you understand how to utilize it for your benefit. And one of the things that's really important in this conversation too, Aaron, the general belief is that the wealthiest among us simply play by a different set of rules. And that's just not true. In fact, A constitutional mandate is that if a tax benefit is available for one, it's available for all. But you just have to know what it is. And the tax code right now is nearly 6,000 pages long. And I haven't read every page. I'll just go ahead and confess that. But 99.5%, or about 5,973 pages, tell you how to avoid paying taxes. There's only 27 pages dedicated to raising taxes. So if you can begin, and not you specifically, but if individuals and families and high income earners can begin to adjust their thinking and begin to look at the tax code as a series of incentives that the government gives in order to get you to do what they want you to do, then you begin to say, well, now my goal is to be paired with a competent advisor or a set of competent advisors who can align my interest, goals, and values with the incentives the government is giving to pay the least amount of taxes possible. And it seems kind of overly simple, but nobody does it.
Yeah. Yeah, I think that's wonderful, man. You do such a good job of articulating it, making it very clear. So I'm taking notes as we're speaking. And you said something which is interesting, is that there's a different way. And what I wrote down right away is, why don't more people take advantage of it? And also what came to mind was perhaps just knowledge and information. So can you talk like a little bit about that? I'm aware that a lot of what you do is teaching, just teaching people what's available.
For sure. Yeah. And I think that's a valid point. It's sort of like throughout a typical career where someone might be a high income earner or high net worth individual, they're going to get bits and pieces of, hey, I heard you could do something like this, or hey, isn't there something like that? And so you've got all these things kind of floating around in your brain or in your peripheral vision. But not only is it not clear exactly what to do with those, but here's where it becomes even more unclear. How can you systematically and strategically pair those different benefits together to amplify the value to your personal wealth structure? And that's really what we do. How we say it with our clients is, we're looking to pair and stack deductions and credits that align with your vision and values.
And what you're describing has been very true for me in my experience, because as somebody who, is very focused on income generation, I'm spending 90 to 95% of my time on that particular activity and the skill sets that are required in order to be able to accomplish that. And very little, it's precisely what you're describing. Like, oh yeah, like I heard something like that. Like, is that true? Like, I don't know. And it's not, you're not actually dedicating any time, energy, or effort. And my experience has been, is that you can outgrow information.
That's a good way to say it. Yeah, I like that.
So in other words, like, the information I was receiving at one stage, at a certain level of income and a certain level of wealth, I realized that I outgrew that information, and it required me to get a higher kind of level of information and to connect with, people like you. So you talk about like pairing and amplifying, pairing and stacking. So within the vein of a high income earner, and let's say some of the folks that are listening to this are real estate agents that are producing income at high levels, what would be some of the, kind of strategies that you can use as far as pairing and stacking? One of the things that I heard you talk about was the real estate professional status, REP. And I think you know a lot about that. So I'm imagining that might be something that you can share as like a tangible, bite that people can take and perhaps do something with.
Imagine that you're on a buffet of tax benefits. And so each individual is going to consume not only different quantities, but different combination of those tax benefits in accordance with their personal interests and, sort of appetites. And so, we talked about this just before we hopped on. There's nearly 500 tax deductions available just for business owners alone. And so it's like, who can sift through all that? And the average individual not only doesn't know that that's there, but they don't even know how to process that information. And so one of the things in any situation is saying, okay, here's who we are, here's where we are, and here's what we want to do. Now, how do we get to the right, plate of food on the buffet, so to speak. And so I think a combination that I see more often than not is that real estate investing and real estate ownership seems to play a critical role in most multi-generational wealth.
What I'm also aware of, though, is if you utilize the services of somebody like yourself, or people that can help you to be tax smart or tax efficient, that supercharges what you're doing. And
Yep.
it'll allow you to get to, if you even have like a freedom number in which I'm like the guy you were mentioning, where he wants to make 500,000 in income,
Yeah.
Residually. It's like, okay, well, in order to do that, you probably need not 20 million, probably 10 million at 5%, like invested. So it's like, all right, well, you can do that probably if he earns 2.8, he could save $1 million a year, and in 10 years he'll get there. What I'm also aware, though, is that if he does this, it'll supercharge and he can get there in half the amount of time.
That's exactly right. Yeah.
Yeah.
So what most people don't realize is if you're a high income earner, you likely already have the tools in play that you need to go where you want to go. But one of the things about high income earners is they're always focused on earning more income. It's just like, you wake up and that's what you think about. And that's why you are where you are. But the downside of that is oftentimes you overlook what's right in front of you that could significantly increase, or I like the term you use, supercharge. So let's look at an example just for conversation purposes. Let's say you earned $1 million a year as an income earner, and it took you X amount of time. What if you could scale back the trade you're making? Because there's trades in life, right? You're trading your time for compensation, right? So that means that you're now not able to do other things because you've made that trade to get to that $1 million of income. What if you could simply scale back and get 35% of your time back, but only make $650, but keep all of it? You just gained 35% and you end up in the same location as if you earned $1 million. And that's real financial freedom, is where you have control over your time and you no longer have to make that barter time for money.
Yeah.
And so it's being more efficient with what you already have. And real estate agents and real estate professionals, those that are involved in what Section 163 of the code defines in real property trade or business, and you have an advantage that the rest of the population doesn't. And here's just the simplest way to explain it. The IRS essentially deems, and I'm oversimplifying here, and just to be clear, I'm not a CPA or a tax attorney. I don't involve myself in giving advice legally or accounting, but we do involve ourselves in all aspects of tax efficient wealth management. And we work in concert with CPAs and tax attorneys to make sure that's done right. So if you are a real estate professional, the IRS views you as A. And then they simply say, if you're not that, you're then B, which is not a real estate professional. So you either are or you aren't. And the implications are tremendous. And just to be clear, I'm not a real estate professional because I can't meet the criteria. So I'm not given this advantage. And a real estate professional, essentially what it allows you to do is to invest in any or all kinds of real estate and get tax deductions against your other income that non-real estate professionals don't get. And why that's important is, let's say that you are a high income earning real estate agent. You could, if done correctly, as a real estate professional, invest in real estate that you have little to no involvement in, that's passive income as long as you meet material participation thresholds and a couple of other things. You could then take the tax deductions, which are tremendous right now, which is some of the stuff we've talked about with bonus depreciation and otherwise. You can take this passive investment and turn part of your real estate agent income into tax-free income. The doctor down the street can't do that. Not that way, at least. Now, he still has the opportunity to do it, but not with all of the opportunities that you would have. So it truly is like you're a unicorn right now if you're a real estate professional.
Yeah, I love that. And I don't know if you guys caught what he just said there. It's so powerful that because of what we've chosen to do as a vocation and because of the rules and the way they are now, and we discussed that they're in the process of changing and scaling back, and they're subject to kind of government changing rules. But at the moment, the way they sit right now, that you can invest in real estate that is passive in nature, whether that be like a syndication or something of that nature. Or if you invest in an Airbnb and somebody else runs it, or whatever the investment vehicle is, and then you can take accelerated depreciation, which you do which the syndicator would do on your behalf, or you can do a cost segregation analysis. You can get one big depreciation instead of over 27 plus years. And then you can use that to not only write off against the income that the property generates in that calendar year, but also against your earned income. Is that what I understood correctly?
Yeah. I think as a summary, that's accurate. The only thing I would add is there are individual nuances like material participation or other things that you've got to meet in order to, what we'll say, activate that deduction against any income. So that deduction is yours just by way of investing in real estate.
Correct.
What you get to use that deduction against has directly to do with what you do for a living and how you follow the dotted I's and the crossed T's of the code to make sure it's done correctly. So that deduction is yours just by real estate ownership and investment. And then how you use that or what you get to use that against for real estate professionals is the broadest category of any professional vocation in the country.
How do you feel that this information, so I'm very clear on why this would be helpful to agents and helpful to high income earners. So how do you feel that this information could be helpful for agents that have high net worth clients?
One of the things, so we work with high net worth and ultra high net worth, up to 9-figure families across the country. And most high net worth individuals have a team of advisors. And what you've seen is a growing surge, not just in the financial industry, but the medical industry and other, even legal industry, where people become extremely specialized in one area and they really don't want to talk about or interested in any other area. And so it's like, well, you can't have 47 professionals on your team, right? Like you've got to have at least somebody who's able to direct or advise or oversee or harmonize those professionals. So with high net worth and ultra high net worth individuals, one of the most important factors for them is being able to understand what are the benefits to me now. So I synthesize that into cash on cash return. How much money am I putting in the deal and what am I getting back right away? So that's the bottom line. And, real estate is one of the only investments, in fact, the only investment I've been able to find that can pay you in 4 ways all at the same time. You're getting appreciation, and it's not just on your investment it's on the bank dollars as well. So you're getting appreciation. You're getting tax benefits through depreciation, like we're talking about a little bit here. You're getting cash flow, and you're getting a third-party tenant to pay down your debt or create more asset value year after year. I can't find any investment yet, at least, that can pay you in 4 ways. So for a real estate agent who has a high net worth individual, the conversation is really actually simple. What if you could own an asset and the government partnered with you to do so? Or what if you could own an asset and the government gives you a refund to do it? Because you have to understand the government's perspective, just as what you mentioned earlier, Aaron, they view housing as a national security issue. If you don't have people that are sheltered, you have potentially an uprising. I mean, it's that simple. So we need to incentivize real estate development, ownership, remodeling, and expansion over and over again. And the U.S. has grown at a more rapid rate than the rest of the world over the last 35 years, and we're projected to do so over the next 30. So let's say, you're a real estate agent and you've got a back surgeon that makes $1.5 million a year, and he works for the hospital, so he is getting crushed on W-2 taxes. I mean, he's paying $700,000 a year in taxes. And you just simply ask him, what if we could buy an asset that would give us a tax deduction that would turn part of your surgeon income to tax-free income? I mean, he would say, sign me up. Where do I go? I don't even need to hear anything else. Mm-hmm. And what we're talking about in that case is short-term rental real estate. It allows that surgeon, if done correctly, to activate the deduction from real estate ownership and offset part of his surgeon income and turn it to tax-free income.
Right. So in other words, like I remember you talking about this to clarify. So how you mentioned that real estate agents or people in the real estate profession, if they can pass the qualifications and the hurdles and they document, they have this very special status called the real estate professional status that gives them a lot of different advantages, right? And for someone like the surgeon, he's clearly not in the real estate industry. Yeah. I don't know how he can stretch that to say that he is or she is. And at the same time, though, there is a provision for that type of investment vehicle, which is short-term rentals like Airbnb or things of that nature, that he can still get the same type of advantage as far as accelerated depreciation is concerned. So when done properly, he could buy that property. He could do a cost segregation analysis. I remember you saying land can't be kind of utilized. So on the building itself, so the land can't be depreciated. And then he can get one large deduction all at once instead of doing it over 27 and a half years. And he or she could then use it to offset their income for the calendar year.
Yeah, that's correct. And so let me even take it a step further. There is no type of individual that would be excluded from purchasing real estate and using a tax deduction for it. Everybody from the business owner to the surgeon we were just mentioning, to the real estate agent, to the multi-generational trust fund baby, to the retiree. There is a proper way to activate the deductions available in real estate to any type of individual. I mean, you can get crazy tax deductions on car washes and gas stations, hotels, warehouses, industrial centers. I mean, the list goes on. So there are not only a plethora of different type of real estate investments, but they can meet the needs of any individual for tax benefits.
I love that. Hey, and I'm curious just from my own knowledge, because I'm aware with multifamily, which is what I'm the most familiar with as far as syndications are concerned.
A lot.
Yeah. And I know some of the largest institutions on planet Earth, whether they be hedge funds or insurance companies, they park lots of money in apartment buildings because they function, particularly if there's lots of units, they function like utilities where every month rents 8% of the rent roll turns over. You can raise rents or lower them. And, it's a very safe place to put money. So, and I'm familiar with that. And I know that as a syndicator, if I'm involved in that type of investment, I'm a limited partner, not a general partner. But I still get, because I'm a partner, I get a K1, so I get depreciation. It gets passed through to me, right? Now, I'm wondering on these other vehicles, if there is a syndication, whether it's, could you still do the same thing with let's say it's a car wash syndication, or if it's a gas station syndication, could you still accomplish the same? Do you still get the same pass through as far as benefits are concerned?
Yes. So to be clear, gas stations and car washes are eligible for what's called Section 1250 property, which means they're actually allowed and so let me back up. Not all gas stations and not all car washes are meet the criteria, but gas stations and car washes are eligible to meet the Section 1250 criteria, which allows them to be accelerated at 100% of the building value up front year one.
Wow.
Let me give you a real scenario.
Yeah.
You have a tenant who's in a gas station, so paying rent, right? You go in as an investor and buy a $2 million gas station. The building value is 1.6 and the land is 400. In that scenario, via bonus depreciation and section 1250 property criteria, you would get a $1.6 million deduction up front year one.
Wow.
Now, again, going back to what we said earlier, because this is financial education, it's not an advice that everybody should go out and buy a gas station, but educating individuals to say, now, how you activate that deduction depends on what you do for a living, what your other income sources are, right? There's a whole set of criteria, but you want to know why a 7-Eleven is popping up, or depending on where you are, if you're in the north, it's the Wawas or Sheets down in this, right? You want to know why Quick Trips or whatever are popping up everywhere. It's because the tax benefits are insane.
They're enormous.
And the same thing for car washes.
And when you think about that, like at the one point, you said it was like a $2 million purchase price, let's say. So if you put 20% down, it's 400 grand. At the same time, a 1.6 deduction on income at the 35-40% tax bracket, you basically bought a piece of real estate for free.
Exactly. So think about that. You own an asset that produces income and you got no money in the deal. There's no skin in the game. There's no risk then. What's your risk? You have no money in.
Yeah, it makes me think, because I read recently like this some very wealthy family, they bought like a hotel on like Miami Beach, and I'm like, why would they do that? But it's like, well, yeah, because if the hotel's $20 million, you get like, if the land's worth $3 million, you get a $17 million reduction year one.
That's right.
Which is like crazy. Now, I'm also curious too. Is that deduction like it rolls over? So let's say you only use, or does it? Like if you only use like half of that 17 million year one, does it roll over to the next year and you can use it the next year?
Yeah, that's a great question. So any depreciation deduction, depending on whether it was active or passive, based off of real estate profession versus not, all of that is a carry forward for you. So so somebody would say, well, I don't have $1.6 million in income to offset. Why should I do that? Well, my counterpoint would be, one, maybe you shouldn't do it. Maybe gas stations ownership is not right for you anyway. But that benefit, if it decreases or declines in value because bonus depreciation is declining starting next year, why would you not capture it all this year and carry it forward and use it over time?
Because you can use it over time, to your point. And then in a year, let's say you make a bunch of money. Cool, you got it. Or let's say one of your other assets, you sell it and there's a huge capital gain. You can offset it with the depreciation, correct?
Yeah, what we're talking about, or what you're alluding to, is taking available deductions and credits, stockpiling them, right? And then saying, how and under what circumstances could or would I use these deductions in the future? And sometimes that means you get to use it all right away, but other times it means you get to use them over time.
Over time, which is pretty interesting, because as we're talking about this, what's popping off in my brain is that, let's say because the rules are the way they are right now, and with multifamily specifically, you can get 100%. I think next year it's 80% and so on and so forth. They're kind of going to phase it out unless they change the rules. But at 100%, if you've been doing that over the last 2 or 3 years, you've probably accumulated like a meaningful amount of losses on paper, like depreciation. And then over time, you can use all of that. Let's say you don't want to write it off against your income if that's not the strategy, but you can, let's say all of that real estate is producing $100,000 in residual income. You can offset all of that until you run out of that loss, which is wild, because if the return is normally like, let's say 5%.
Bingo.
But if you're writing that off, it's really at a 35-40% tax bracket. It's really like 9%.
Yeah. And I would say when you factor in all of the benefits of real estate, it is not unreasonable to see easily double-digit returns when you factor in all of the different ways. And again, that's on a deal-by-deal basis, right? I mean, there's the metrics that go into, but we're seeing clients with significant cash on cash returns when you think about all the ways that real estate can pay you. And so let's go back just for example, and this is just sort of a cherry on top kind of thing. Let's go back to the example with the gas station where, again, we're not factoring in things like the individual and all the bank terms and all that. We're just talking high level financial education. Here's a scenario. And I actually got this scenario that I'm about to tell you from one of the national CPA teams out of Scottsdale, Arizona, that is excellent in this space. And imagine you purchased that $2 million gas station, you got $1.6 million deduction, and theoretically, you put 400 in and you got 400 back because of your, maybe even a little more than that if your tax rates are higher, right? Because depending on your federal tax rates. What's important to note is we're talking about federal tax rates only. Most states do not recognize bonus depreciation, so this is a federal benefit. So imagine if you then go in and put solar panels on top of that gas station and then a couple of charging stations at the front. You could literally see 150 to 155% returns on your money, meaning you have no money in the deal, and then the government is paying you additionally via tax credits and deductions on these solars. And so again, there's a lot of nuances that go in there that's not meant to be an example for you to take to your CPA and tell me some guy says I can make money. That's not the point. The point is by strategically stacking deductions and credits on top of what you're already doing, it turns, and I love the word you used earlier, it turns a Mercedes at 75 miles an hour to a race car at 200. I mean, it supercharges your wealth building and your tax savings if you can do it the right way.
Yeah. And that's why it's so critical to have, the right team around you. And to that point where you said about the charging stations, I have a Tesla, and I remember when you said that at the meeting, I was like, oh, that's why I've seen offices put charging stations outside. I was wondering, like, why are they doing that? Or, oh, that's why they're putting solar panels on top, because there's and again, it falls into that category: housing, energy, food. And if you're participating in those, there's probably like a really big tax advantage. So listen, brother, this has been like exceptionally helpful. I know I've learned some stuff. Hopefully people have learned some stuff as well. And I think that you're also, someone that can definitely serve as a resource. I'll talk to you about it off camera, where maybe I can connect you with some of our clients that can definitely use your help. So if people want to find you, whether it's to get educated, have a conversation, where can they find you?
So we're in the process of that part, but right now they can go to our website, which is Harbour, and we spell Harbour, Harbour. So harborprivatewealth.com. We've got a video library, and we're updating that multiple times a month. But other than that, finding a way to connect to our team via email or phone call is probably the best way to say, hey.
Again, I encourage you guys to reach out. He's the real deal. As you can tell, he's sharp as a tack. And, I think you'll be in great hands with him. So if you like this episode, you think that somebody else could get value from it, be sure to share it, and smash the like button. Also, be sure to subscribe so that way you get all of the new episodes as they become available. So again, appreciate you, brother. Appreciate you taking the time. And I look forward to connecting with you soon.
Thanks, Aaron.